Okay, we're going to get started today by looking at the front page of the Yahoo Finance website. Some of the most important news for today is jobs slowdown seals Fed cut as White House blasts Powell. Okay, so we have a couple stories about a job report. We had a job report that basically um, there's not as many jobs added to the payroll this month. It's very, very low. So that indicates that the economy is slowing. And when the economy slows, that means companies in general are less profitable, number one. Number two, the Federal Reserve is pressured to cut interest rates to stimulate growth. So if we look at the 10-year yield, you can see it drop like a rock. This is a lot. So you can see it's been falling. That's kind of in um, as the economy slows and as reports come out that indicate that there's less job growth, there's less manufacturer activity, et cetera, the yield to the 10-year goes down. And if we compare that, of course, to the S&P 500, there should be an inverse correlation. So um, so as the yield goes down, we should have had an update today, but it was not up, it was down. So if our inverse correlation continues. So that was the most important thing that happened today. Another important thing, um, there's been there's been some, let me see, there's been some talk about the AI trade kind of being overvalued. We'll talk about that a little bit later on. But um, we had a report from Broadcom this week that was really good. And so we have some conflicting um, news stories. You know, Broadcom says that things are going good with AI, and then we have Goldman Sachs coming out and saying AI is overvalued. Um, some of the other topics that are important on this homepage: why Anthropic's copyright settlement sucks for writers. Basically, we have a lot of hints on this front page that AI there's a lot of fleas on the dog of this story. We have Anthropic, which is one of the biggest AI startups. They were sued for copyright infringement because they were using copyrighted um, material, maybe pirated, for training their models. Also, they're liable if they use that copyrighted content in their AI. So we have a one flaw possibly, and um, we have a lot of hints that the AI is kind of over exaggerated and overextended. We have some hints that AGI, which is general intelligence, artificial general intelligence, is like not even achievable. And we've kind of reached the max we can possibly go with artificial intelligence. So we'll go over that a little bit later, but that's one of the biggest stories of this week. Um, Here's another story. AppLovin, Robinhood, MCORD set to join S&P 500. It's interesting. We went over AppLovin last week as an undervalued stock. So that's a little bit of a um, whenever you come across a stock you like and you think it's undervalued, and then someone like Warren Buffett or the S&P 500 adds that stock, that's a little credence towards it being a decent investment. So we'll go over AppLovin and Robinhood later on. All right, over, let's look at the S&P 500. You can see that we are hugging the 200-day exponential moving average. You can see that is been a form of major support since the April lows. As long as we're going above that line, we're okay in the stock market. We're going to continue going up. But as soon as we break that, like we did right here, there's a chance that we go down to the 200-day moving average. And that's like 10% or 15%. You can see we're halfway between we're overbought right now. We're at probably 67, wait, we're at 69 on the slow stochastics. So that is overbought. So, and we are approaching, um, seasonality wise, the worst month of the year, September. So the whole market knows that this is a seasonality. Seasonality wise, it's the worst month of the year. On TV, they say it every other sentence. And if there's just one reason to sell, there's going to be some profit taking. But the important thing to realize is some of the best setups, some of the best times to buy stocks during the year is during a sell-off in September, because normally there's a Santa rally, there's a November and December time period which is really good, and October. Um, but a lot of people are freaked out during September timeframe. So if you see a good quality stock going down in September, just realize you got this trump card in the back of your pocket. We got this the rest of the year that are usually positive. Doesn't work out every time like that, though. Like a couple years ago, 2022 or something, we had 20% drop. Um, but over time, there are reasons the last 3 months of the year are positive. We have pension realignment. We have people that have to contribute that are 401k. There's a lot of forced buying, and there's a lot of managers that are catching up with performance-wise the rest of the market. So you have a lot of chasing, a lot of reasons the end of the year is good. But you'd have to realize we're going to have a lot of volatility this month. This is one of the most volatile. This is the VIX month to month. It's one of the most volatile months of the year. So that's something to keep in mind. All right, let's go look at the S&P 500 trend line. You can see we're at 67, that's overbought, and we're basically right, just hugging this trend line. So we're like halfway, no, 1/4 of the way between these two trend lines. So it's continuing an uptrend. Whenever it breaks this trend line, then we know there's a good possibility we'll go down 10 or 20%, or down to the next moving average of support. Okay, let's look at, and the reason why we're going over this market timing, the overbought, oversold, is if you're not invested, or if you have some money to invest, you want to invest whenever the market is oversold, and whenever the market is overbought, you want to don't sell, don't buy or sell some. That's kind of the timing that we follow here. All right. So let's look at, okay, our variables in the stock market aren't changing a whole lot. Oil isn't changing much. We have inflation kind of consistent at 2.7%. Gold is up 1%, and US dollar continues to go down. And as we see the US dollar trending downward, we know that that's going to help the big tech stocks or any multinational stocks with their earnings. In our fear of greed index, we're still at greed, um, and we're still bearish in the AAII sentiment survey. So when it's bearish, it's time to buy or not to sell. That's contrary approach. And when there's greed, you take some off the table. Okay, so the VIX is still relatively low at 15. So there's not a whole lot of fear in the market right now. And we're probably right here. We're still at the new paradigm kind of greed in the stock market right now. Um, all right. All right. Let's look at our let's look at our first to worst. Beginning of the year, last year, we had communication sector, IT, and consumer discretionary the highest in financials. And now we have the communication services up the most this year. IT is up 14%. That's second best, along with industrials up 14%. The worst performer this year is healthcare. It's up less than 1%, and energy up 3%. The reason energy is down so much is the price of oil is down, and all the energy stocks kind of follow the price of oil. So, and to go along with our economy is slowing, as the economy slows around the world, and as the economy slows in America, there's less demand for oil. So that makes the price of oil go down if supply is the same. All right. So, okay. Goldman Sachs came out with a story today about how the AI stocks are overvalued. You can see that the IT sector is in a 90 percentile. Consumer discretionary and industrials are all very expensive. Um, and the S&P is expensive too. So the most least expensive stocks right now in compared to history is energy, financials, healthcare, and real estate utilities. The interesting thing is these don't grow as fast. So people are paying a premium still right now for these sectors. All right, so let's look at some of the stocks going up and down the most today. First, um, let's look at the 10-year. You can see that we're going down in the 10-year. So let's look at our cheat sheet. Yield of the 10-year going down. That's positive for small caps, stocks that are heavily indebted, cost to refinance to borrow money, any stocks that are in debt or need to borrow money will do well. High yielding stocks, they will benefit because as a guaranteed yield of the US Treasury goes down, people are going to be reaching for yield and wanting to buy things with higher yield. That's why utilities, healthcare, consumer staples will do well. Home builders will also do well because mortgage payments will be lower with lower interest rates. Um, all right. And it's negative for large caps tech stocks, financial sector, and insurance companies, brokerage firms, and insurers. Let's see if that panned out today in our top sectors of the market. So let's look at the sectors. Um, okay, oil and gas exploration, energy. Actually, the price of oil hasn't changed today at all. Look, it's almost nothing. But the price of oil has went down. Why would that be? That's well, we had the job report that came out that said that there were less jobs added to the payroll in America, like 22,000, and they expected a lot more than that. That's an indication that the US economy is slowing. And a lot of times when the US economy is slowing, the rest of the world slows with it. And when there's less economic activity in the world, the demand for oil goes down. So that could be why the price of oil is going down or the energy stocks are going down. Um, another energy ETF, Financials, okay, that followed our pattern as the lower interest rates are bad for financials. And we have another oil, regional banking, financials, um, bank ETF. Okay, utility sector. Okay, I was surprised utilities would not do so well today. Well, that could be because we had a story about the AI. Goldman Sachs, we'll go over later. Goldman Sachs says the AI stocks are a little bit overvalued right now, and the utility sector is part of that. Let's look at the stocks that went up the most. We have XME, mining and materials, mining and metals. We have gold miners. Okay. Um, so we had some volatility in the stock market today whenever there is volatility, and we have the 10-year yield going down. People gravitate towards gold and precious metals. And also we have the US dollar going down. As the US dollar goes down, commodity prices go up because they're priced in US dollars. So, and then home construction ETF. Okay, as interest rates go down, homes are more affordable. We've been talking about for a couple of weeks now, home construction and how they would benefit from lower interest rates. And biotech ETF, they need to borrow money, biotechs, and the price of borrowing money goes down as interest rates go down. And home builders, and we already went over that. Um, Semiconductor ETF, real estate. Okay, so we have real estate. Real estate benefits from lower interest rates because more people can afford to buy real estate. All right, that made sense. That was a good exercise. Okay, so let's look at Dan Mal's picks. KBWB is still good, and Cisco is still his best pick. We'll keep following that. And I picked out some very interesting charts. Right now, Meta is out of favor. It's you can see it's at the bottom end of its range, and it's oversold. This is an example of a stock that is in a majority of the big mutual funds that we follow. And it currently it's trading above its 200-day, which is right here, and it's hugging the 50-day moving average, which is the purple one here. So you can see that it does have momentum. Um, some of the some of the some of the good things about Meta are they're very innovative. They're coming out with they're not afraid to invest. They're putting a lot of money and research into AI and the future. They're making glasses that you can put on for augmented reality. They have a lot of new shots on the goal, as they say. Um, and they're very profitable too. So this is an example of a stock it's out of favor right now. It's a little bit overvalued, but it's oversold. Let's look at another one. Okay, Pepsi. You can see this massive downtrend here that was for a couple years in the making. Now, as volatility picks up in September, people are going to be gravitated away from high PE ratio stocks into things that are more conservative. And this is an example of a stock that's it's oversold right now. It's at the bottom of its up trend line, and I've owned this since 2010. Right now, the it's not a very good growth story. It's not growing like at all, maybe 1 or 2%, but it has a dividend, and it's a conservative thing that you can have in your portfolio. This is waste management. You can see that it's oversold right now. It's growing um, in good times and in bad. So if there is a recession, if there is a calamity in the stock market, if AI stocks drop to nothing, people still have trash that needs picked up. And they have a duopoly with Republic Services, and they have a natural monopoly duopoly because it's really hard to get permits for trash disposal in America now. And because of that, that restricts competition. So they're making money by raising their prices. They're growing by raising their prices over time, and they are getting money from recycling and getting methane from their landfills. So they have multiple ways of making money. So I like to buy stocks when they're oversold. This is oversold and near the bottom end of their trading range. All right. The next one is NVIDIA. Okay, we can see that this is oversold. It actually had a negative story today. The issue here is that whenever we have a historically bad month of September, and you have Goldman Sachs coming out with a story that AI stocks are overvalued, you have a good combination that could lead to volatility. So we are at the bottom end of this trend line and at the 50-day moving average. But if we have volatility this month, it might actually come down to this 200-day moving average. It's oversold already, but when there's lack of confidence in the AI story, people will not pay a high multiple for stocks. And that means it's a little vulnerable to price going up and down. All right. The next one is Costco. You can see this is a more conservative stock. Its peg ratio is like really high, like 4 or 5, but it consistently returns like 10% a year. You can see it's oversold and it's near the bottom of its trend line. So this is one of Charlie Munger's favorite stocks when he was living, and it's they make most of their money with renewal of membership fees, and the renewal rate is around 95%. So they have a good following of people that will keep them growing around 10% a year. Um, okay. So let's look at our stock screen. We mentioned App 11 last week. We said it was undervalued. According to Yahoo, this Fidelity screen, it was 15% undervalued. So I thought it'd be interesting to follow up with that. Just this week, App 11 and Robinhood were added to the S&P 500. Um, so App 11, we mentioned that it was a little undervalued, and it was well. It was a quality stock we mentioned last week, but we found Robinhood added to also. So I thought it'd be interesting to go through Robinhood this week. You can see that they had a lot of growth from last year to this year, 41%. But this year they're only growing at 13%. We have to figure out how Robinhood makes their money. Um, I think they make most of their money with order flow. So let's say the Citadels of the world. Um, I guess they give a little bit of extra premium if you route some of your trades through them. So that's how they make a majority of their money. And now they're branching out into specialized products, and they're selling crypto like things and um, tokenized stock, tokenized things. So they're very innovative, and they're creating services and ways to make money with their customers. So let's look at what their 4 PE is 50 and their growth is 13. This is very surprising that S&P would add this company because it seems like it's overvalued by 4 times. If you divide the PE ratio 50 by what it's growing at 13, then it's 4 times overvalued. But we like the profit margin is 50. That is four times more than we want. And then return on equity is 23. That's double what we want. So that those are really good numbers. And they have 6 billion in cash. So they're a very profitable company that um, just a little bit they're four times overvalued right now. Um, but they have the opportunity of growing 22% from next year to the year after. So it's a little inconsistent earnings like this. I like to see um, if I was investing in this stock, I would want the peg ratio to be closer to one. But yeah, it's a little bit overvalued. So we'll watch this one. Um, let's see what CFRA says about Robinhood. They said they're overvalued by 33%, 33.8%. So that seems so they agree that it's overvalued, but only by 33%. And let's look at the chart of Robinhood. You can see this is a very, very strong chart. They're oversold right now. You can see that they're oversold and at the bottom end of the range. So this is an example of a perfect time to buy a stock. Of course, they're going to pop Monday morning on the news because all S&P fund managers have to buy the stock. So to add it to their index. So it's probably going to be up to here in a couple weeks. Okay, so but right now you can see it's super oversold. Let's look at the Apple oven. We went over this last week. You can see it's in a really, really nice uptrend, and it's at the top end of its range of our trend lines, but it's overbought. So um, it's going to obviously go up 6% on Monday, like the other stocks added to the S&P. All right, so let's look at this front page of the Yahoo Finance again. You can see that we have some red flags for the AI story. We have Attorney General warns OpenAI harm to children will not be tolerated. So we have a feature of AI, which is hallucination, which, you know, or a form of that is inherent to the platform. Right now, there are actually consequences, for some of the actions of AI. We have AI companies being sued for what the AI agent tells the user to do. So that's one. Yeah, we have harm to children possibly. We have uh, Google Gemini dubbed high risk for teens and kids in a new safety assessment. Okay, so we also have this Anthropic to pay to settle author class action. So the means that the AI companies are generating these LLMs and their business could be faulty and it could unravel the whole story. So this is just like a canary in the coal mine, as they say. So you got to watch this to see if it actually has any credence and if it has an effect on the stocks we're following. Okay, so this Goldman Sachs issues a warning to AI stock investors story came out today, and a lot of the tech stocks that were AI related went down in sympathy with the story. And this guy Hammond, he thinks a percentage of capital expenditures could be nearing a climax. In turn, that sets the stage for an overly upbeat AI investors to be let down if earnings don't come in strong. Okay, so basically the story with AI is that the major tech companies have been spending wildly, um, hoping that their spend will pay off. And a lot of them are trying to achieve like an AGI, a artificial general intelligence or a super intelligence, as um, Mark Zuckerberg would say for Meta. So, and that might not be achievable. They might have reached a plateau, and putting more money to something that doesn't work might yield a bad investment. So, it's all kind of coming to a head right now. So we'll have to see. We'll have to see if any of this is true. So another thing Goldman Sachs says, implied market pricing of long-term S&P 500 growth earnings and evaluation of large TMT, tech, media, telecom stocks are both modestly above respective historical average, but below the tech bubble of 2000. All right. So we've been saying PE of the S&P 500 is 25, and that is traditionally high. The average PE is 18. So this kind of mirrors what we've been saying. And one thing they mentioned in the article are two stocks that are overvalued. One is Tesla and one is Palantir. So I thought it'd be interesting to go back and look at Palantir and Tesla as investments right now. So Palantir, they're growing at 31%, and their PE ratio is 182. That makes them 6 times overvalued. So that basically means whatever price they're trading for now, 150, you can divide that by 6, and that could be a price that it drops. So you got to be ready for that as an investor. Um, so that's really pricey. You can see the profit margin is double what we're looking for. Operating margin is double what we're looking for, which both are good. Total cash, they have more cat. They have 6 billion in cash, and they're a profitable company, and their return on equity is 15. That is just on line what we're looking for. So they're 6 times overvalued. There's a lot of hype with this stock. Like it's the best performing stock this year. It's like up to 100%. But um, there's a good chance it could drop by a multiple on a bad news story like this one, or um, and it also can keep going up. We don't know how long bubbles can go until they pop. So we'll watch this, but I'm not one that would invest in a stock like this. Okay, let's look at Tesla. Tesla had negative earnings year over year from 24 to 25. Um, but their earnings from this year to next year are scheduled to grow at 43%. I'm not sure how that's going to happen, but let's take these. Um, we'll just assume that their growth is 44%. So if they're growing at 44%, the PE ratio is 133. The PEG ratio is 4. That means it's 4 times overvalued. So if you take the current price divided by 4, that could be a worst case scenario for Tesla stock. The total cash is 36 billion, and um, total debt is 13. So they have 23 billion in cash, and so they're not affected by borrowing money. And let me see. Okay, so they're a profitable company. They have positive free cash flow. All right, so that's the first stock we look at. Let's look at what they say at CFRA. They say that it's overvalued by 44%. That's that's a lot less than what I thought it was. I thought it was 6 times overvalued, but it's only 44% overvalued according to CFRA. I'd like to look at this earnings year over year. You can see that they were not profitable until 2020. They started to be profitable. They doubled, doubled, doubled. They were up 20%. But look at that. They dropped their earnings in half from 23 to 24. Um, One of the biggest problems with Tesla right now is they don't have EV credits, and they had a kind of, as Elon Musk was working with the government, they had a bad news story affecting how people like the name, the Tesla name. So and there's a lot of competition for EV. So I guess Elon Musk says that they're counting on the robot, their Optimus robot, for growth in the future. But right now, their stock is um, kind of halted as their growth as a growth company like this year. We'll see if it continues to grow at 40%, but I think it could drop by 4 times in a bad market or a bad news story. We'll see. But you're paying a lot right now for the future, like robotaxi and for Optimus. If Optimus robot, the artificial intelligence robot, if they take off, then this stock is worth a lot more than what it's trading for now. But we don't know that, and we don't know how the products will do in the future. So we'll see. But we do have an innovative CEO that could basically make anything happen. All right, so let's look at this is Morningstar. They say it's only overvalued by 35%. So that's very similar to the 48% of CFRA. So all this kind of confirms what Goldman Sachs was saying, that this is an overvalued stock. Let's look at Palantir. Um, there's a buy recommendation at CFRA, and they say the price target is 199. They say we maintain our buy rating on Palantir on its stellar performance and strong full-year outlook. The company is clearly a winner in an AI revolution as it scales velocity, accelerates quarter after quarter. Okay, I looked at the one problem with this CFRA is they don't have a fair value calculation for Palantir, so it's really hard for me to get my um, my hands on this stock because they don't give that confirmation of what they think the value is. So let's look at let me see. So they think it's a buy, but I think it's overvalued. I agree with Goldman Sachs. Okay, let's look at this new story. Google leads monster week for tech, pushing mega caps to a combined 21 trillion in market cap. Um, Google basically had some good news this week on their antitrust case. They basically were slapped on the wrist, and they weren't forced to break up, which was an amazing outcome for Google. Um, so what happened was Alphabet and Apple shares rallied, and because of the remedies suggested, Broadcom also went up on Wednesday with good earnings, and the Mag 7 continues to dominate the S&P 500. Let's look at the estimates for Google. You can see that this year to next year, they're only growing at 7%. But for the past 10 years, at least, they've been growing 13% a year. So if we average all these together, let's say they're growing at 13%. The P ratio right now is 22, and that is below the stock market, which is 25. So a high quality company like Google trading less than the average stock in the S&P 500, they at least on news like this should trade up to 25 PE ratio. So their PEG ratio right now is 1.69. So that's about 60% overvalued. Um, so let's look at, and Yahoo Finance agrees with those numbers. Profit margin is 3 times what we're looking for. Operating margin, the return on equity is 3 times what we're looking for. And they have 44 billion in cash. So if you take out the cash, their PE ratio would actually be less than 22. It would be something like 19 or 18. So, okay. So it's a little bit overvalued right now, but for me, this is like one of my longest held stocks and continues to grow 13% a year. I first bought this in 2008 and I've been following it every year and it seems to be growing miraculously 13% a year. So this is an example of a stock that's a permanent compounder, and you buy it and you expect it to grow 10 to 13% a year. Oh, right. So let's look at what CFRA said on it. They didn't have an actual report with a fair value, but they did have a little blurb that says CFRA maintains buy on shares of Alphabet, search outcome a major win. So they say we view the news as huge potential positive and clearing event that should allow multiples to expand in the coming quarters as Google demonstrates it is an AI winner. We boost our 12-month target to 270 from 230 and on a higher PE of 23.8. Our 2027 view. Okay. So they basically said that same thing that they think that the PE ratio will go up towards the 30 range, which is where Facebook or Meta and Microsoft and Apple are at. So that'll make the stock go up a little bit. Morningstar says they're 11% undervalued right now. So that's a good, I was looking for that from CFRA, but they didn't give it to us. So they said the fair value is 230. Okay, so that's a good double confirmation that it's a decent stock. Um, let's look at our tech, our favorite tech funds and see how many of them are owning Google. You can see that over 80% of these um, major mutual funds own Google in one form or another. A lot of them have as one of their highest convictions. You can see this is Fidelity Growth Company. It has 5%. And this one, Google is 2%, 3%, 7% in Fidelity OTC. So a lot of times whenever you have a stock and you've confirmed that it's kind of um, a good stock and you see that in the average mutual funds, the best mutual funds, that's a good double confirmations. You got a good stock to buy and hold. Okay, so that's all that I had to say for today. I hope you enjoyed that talk, and I will see you next time.